How do capital gains tax rates compare to ordinary income? Imagine selling an investment and wondering if you'll pay more or less in taxes than on your regular paycheck. That's what we're here to clarify today. When you earn money from work, like wages or salaries, it's taxed as ordinary income. These rates are set by federal tax brackets that range from 10% to 37% in 2025. The more you earn, the higher your rate, with the brackets increasing progressively based on your total taxable income. Now, if you sell an asset like stocks or property that you've held for longer than 1 year, you might qualify for a lower tax rate called a long-term capital gains rate. These rates are only 0%, 15%, or 20%, depending on your income level. For example, in 2025, a single filer earning up to $48,350 pays 0% on long-term gains. If their income is between $48,351 and $533,400, they pay 15%. Above that, over $533,400, the rate jumps to 20%. In comparison, a single person in the 22% ordinary income bracket earns between $48,476 and $103,350. Someone in the 24% bracket earns from $103,351 to $197,300. This shows that long-term capital gains rates stay lower than ordinary income rates at similar income levels. Holding investments longer than a year can save you a lot on taxes. For someone in the 37% tax bracket, short-term gains are taxed at that full rate. But long-term gains are taxed at only 20%, saving 17 percentage points. If that person makes $600,000 in long-term gains, they could save over $100,000 in taxes compared to short-term gains. High-income earners should also think about the 3.8% net investment income tax. This tax applies to both short-term and long-term gains when modified adjusted gross income exceeds $100,000 for singles or $150,000 for married couples filing jointly. When you add this tax to the 20% long-term rate, the total effective rate can reach 23.8%. That means even long-term gains aren't completely tax-free for high earners. From a planning perspective, understanding these differences helps you decide when to sell investments. Holding assets longer than 1 year can reduce your tax bill and help your investments grow faster. Timing sales and managing your income can make a big difference in your overall tax situation. Remember, the 2025 tax brackets are adjusted for inflation, so more of your income stays in lower brackets, which is good news for taxpayers. Short-term gains, on the other hand, are taxed as ordinary income, so selling within a year can mean paying the highest rates. Knowing these rules helps you make smarter choices about your investments and how to keep more of your money working for you.